Pricing. Pricing is the process of setting price of a product which company will receive in exchange of its product. Pricing factors are manufacturing cost, marketplace, competition, market condition, quality of product. A good price policy is of great importance to the producers, wholesalers, retailers, and the customers. Marketeers try to achieve their long-run pricing objectives through both price policies and price strategies. If the prices are high, few buyers purchase, and if the prices are low, many buyers purchase. Thus, market may be reduced or increased, that is, the price increases in relation to the sales revenue. Thus, pricing is a critical situation. Therefore, a sound pricing policy must be adopted to have a maximum sales revenue. This lesson discusses pricing and its various aspects. It follows from the previous slide that after studying this lesson, you should be able to understand how to design price of a product, explain the important factors of pricing, describe the pricing objectives. Price, once fixed, is subject to change before a firm develops the pricing strategy. It should take into consideration the different factors which affect price decisions. These factors are external as well as internal. External factors include competition, government, suppliers or channel members, economic conditions, product stage in the life cycle, and market position of the firm. Internal factors include marketing mix, objectives of the firm, organizational factors, and product differentiation. Price discrimination exists when a seller sells identical goods or services at different prices. In a perfectly competitive market, there are no transaction costs or prohibition on secondary exchange to prevent arbitrage. Price discrimination can only be a feature of monopoly and oligopoly markets where market power can be exercised. Various types of price discrimination include first-degree price discrimination, second-degree price discrimination, third-degree price discrimination. In first-degree price discrimination, price varies by customers' willingness or ability to pay. This arises from the fact that the value of goods is subjective. A customer with low price elasticity is less deterred by a higher price than a customer with high price elasticity of demand. As long as the price elasticity for a customer is less than 1, it is very advantageous to increase the price. The seller gets more money for fewer goods. In second-degree price discrimination, price varies according to quantity sold. Larger quantities are available at a lower unit price. This is particularly widespread in sales to industrial customers, where bulk buyers enjoy higher discounts. In third-degree price discrimination, price varies by attributes such as location or by customer segment, or in the most extreme case, by the individual customer's identity, where the attribute in question is used as a proxy for ability or willingness to pay. Product line pricing refers to a strategy where a single price is kept for all the products in a single product line. For example, such as having a price A for all the high-priced premium dresses, price B for the medium-priced line, and price C for the lower-priced line. Product line pricing has an impact on demand for the other products offered by the marketeers. Variations in manufacturing costs across products are also a factor in product line pricing. Pricing is a problem when a firm has to set a price for the first time. That is, when it launches new product. Companies follow 4-step procedure for price setting. The marketeer has to decide what it wants to accomplish. The different price structures lead to a different level of demand. For that, the marketeer has to formulate the demand schedule. The demand schedule shows the number of units the market will buy in the given period of time at the alternative price that might be charged during the period. For the marketeer, it is necessary to know and analyze the competitors' prices and offers. The price the company charges will be between one that is too low to produce a profit and one that is too high to produce any demand. This slide shows us various pricing strategies. Price skimming is a pricing strategy in which a marketer sets a relatively high price for a product or service initially and then lowers the price over time. It is a temporal version of price discrimination or yield management. Firms follow this strategy so that they recover their sunk costs quickly even before they face any competition, and then they lower the price. Penetration pricing is the pricing technique in which a very low price is set initially, often lower than the eventual market price, to attract new customers. This technique assumes that the consumers will switch to the new brand because of the lower price. Penetration pricing is usually practiced with a marketing objective of increasing market share or sales volume rather than to make profit in the short term. The concept of selling at a loss may appear to be in the interest of the general public and therefore not often challenged. Only when the leader pushes up the prices, it then becomes suspicious. Loss leadership can be similar to predatory pricing or cross-subsidization, both seen as anti-competitive practices. In business, the practice of setting the price of a product to equal the extra cost of producing an extra unit of output. By this policy, a producer charges for each product unit sold only the addition to total cost resulting from materials and direct labor. Businesses often set prices close to marginal cost during periods of poor sales. Competition-based pricing is setting of price of the product based on the competitor's similar product. Till now, we have considered pricing strategies by the firms of a single product line, but in reality, firms produce multiple products. Such multiple products create four different kinds of relationships, namely demand relationships, cost relationship, production relationships, and capacity relationships. Transfer prices are the amounts charged by one segment of an organization for a product or service that it supplies to another segment of the same organization. Transfer price, in simple words, is the price that one subunit of an organization charges for a product or service supplied to another subunit of the same organization. Transfer pricing systems exist to communicate data that will lead to goal-congruent decisions and evaluate segment performance and thus motivate managers towards goal-congruent decisions. Multinational companies use transfer pricing to minimize their worldwide taxes, duties, and tariffs. Some of the more important objectives of transfer pricing are evaluating divisional performance, improving the quality of decisions, promoting autonomy, and allocation of profit. There are three general methods for determining transfer prices. Market-based transfer prices, in which a company may choose to use the price of a similar product or service publicity listed in, say, a trade journal. The basis for transfer price can even be any price that is cost-based. Then there are negotiated transfer prices. In some cases, the divisions of a company are free to negotiate the transfer price between them. In the process of negotiation, divisions may use information about costs and market prices. However, there is no requirement that the chosen transfer price to have any specific relationship to either cost or market price data. Negotiated transfer prices are often employed when market prices are volatile. When market prices cannot be used, versions of cost plus a profit are often used as a fair substitute. In situations where idle capacity exists, variable cost would generally be the better basis for transfer pricing and would lead to the optimum decision for the firm as a whole. There is a large amount of documented sources on the transfer pricing policies used by companies all over the world. These studies have documented various aspects of transfer pricing policies, such as its role as an overall component of reporting and control system in companies, The effect of transfer pricing on intra-corporate conflicts. Variations in transfer pricing policies across the world and environmental constraints on use of transfer prices. Companies tend to look at transfer pricing not just as a mere accounting exercise, but as an important tool in policy formulation towards the achievement of corporate objectives. Transfer pricing acts as a major source of political conflict within the organization, and this takes place irrespective of the method used for this purpose. Different methods may, however, increase or decrease the possibility of conflict. Companies tend to use a variety of transfer pricing methods. However, the dominant among them are the market prices or the methods based on modifications of the market prices. Now let us check if we have understood the various concepts discussed in this lesson clearly. Negotiated transfer prices, in which a company may choose to use the price of a similar product or service publicity listed in. Right or wrong? Wrong. Competition-based pricing is setting of a price of the product based on the competitor's similar product. Right or wrong? Right. Product line pricing refers to a strategy where a single price is kept for all the product in single product line. Right or wrong? Right. Before we end, let us briefly revise what we have studied till so far. This lesson focuses on pricing policy, pricing methods, and pricing of a new product. Pricing assumes a significant role in competitive economy. Price is the main factor which affects the marketing organization. A good price policy is of great importance to the producers, wholesalers, retailers, and the customers. Marketers try to achieve their long-run pricing objectives through both price policies and price strategies. If the prices are high, few buyers purchase, and if the prices are low, many buyers purchase. Thus, market may be reduced or increased, that is, the price increases in relation to the sales revenue. Thus, pricing is a critical situation. Therefore, a sound pricing policy must be adopted to have a maximum sales revenue.